You want to get out of the traditional marketplace, but captives aren't your thing? Nick Starr is here to talk about that. Hello, everybody, and welcome to another episode of The BluePrint. I am your host, Eric Messer, and with me today I have Nick Starr. Now, Nick, you've been in this industry for
basically 33 years,
yes,
but professionally 10.
All right, but you did kind of run around the office, and as a kid, through osmosis, became much more smarter.
I know every nook and cranny.
So we have you here today to talk about alternative risk financing programs, and what you're going to talk about today is not a group captive. So what is it?
It technically is a captive, but it's not a traditional captive. It's a captive that you own solely, your organization owns solely. So unlike a group captive where your outcome depends on those other organizations that are involved in it, you're really the one that's making the rules. You're pushing the needle. So you're benefiting based on your own favorable or maybe unfavorable loss history. But it's a program where you have the ability to benefit by getting a return premium of anywhere from 10 to 50%.
That's huge.
It's massive. It is. And again, unlike the traditional group captive, you can actually include property in this particular single captive.
And more than just that, how many lines?
You can go up to 18 lines. So what's great about it too is you can choose the attritional lines of your business, and you can keep the lines that may have had a few losses that are hurting your loss ratio out of it. So you really can pick and choose to really create the best possible environment for your organization to get the best return back.
Why would they look at this one versus the group captive? Is it because being by yourself, you have more control over pricing versus having 5 or 6 or 7 other construction companies with you, or companies in any industry with you?
Yeah. I'm not going to badmouth the group captive, because group captives can be good and bad. They're good in the sense if you're an organization that tends to have a higher loss ratio, the group can help pull that down. So you're benefiting because others within the group are performing well. At the same time, if you're an organization that typically performs well year over year, why share in your underwriting profits? This model allows you to fully gain all of those favorable underwriting profits because there's no one else involved. And again, one of the big pieces here is property. You know, the group captive does not consider property, so why some organizations might consider this model compared to the group is if you have a large property footprint. So for organizations that are, franchises that have buildings, all over, commercial real estate, residential real estate property owners, this is perfect for them, because typically, especially with new construction, you've got, fully sprinklered buildings, central fire alarm, burglar alarm. The loss history on these is next to nothing. And assuming you have a relatively good risk management program in place, you're doing your checks and balances, you're doing your updates, there's no reason you shouldn't be able to benefit and get actually 50% of your premiums back a year because of that favorable loss history.
So the people that this would be a good fit for, you've touched on it a little bit, but just break down that profile for me.
Yeah, so the profile realistically, when you break it down, is you want to have at least $250,000 in premium with a minimum.
Amongst those 18 lines.
Yeah. Right. So you can really pull it in however you want to do it to get to that $250,000 limit. And then at least a 40% or lower loss ratio. You do not want to be over that 40%, because then it just doesn't make sense that you be in that risk environment. However, we can justify it by just looking at the previous 5-year loss history or more if they're available, and really make a strong, calculated decision on if this program is going to be a fit or not. So it's a very safe play because we've got that prehistory to determine how this account is going to perform.
Okay, and one of those 18 lines, is that workers' comp, or is workers' comp going to stay separate?
You know, you could include workers' comp. It really depends on the profile of the organization. Because Wisconsin is so favorable in the dividends that they give out, you get up to 45%. I wouldn't rely on that because it's not very common, but it can be done. Wisconsin's very aggressive in their dividends, so you really have to play around with what that potentially looks like. But yes, you could include workers' comp. I am typically a proponent of GL property as your two biggest, and then you feed in some of the other.
So when businesses come to us and they're interested in this program, one of the nice things is we have experts throughout the organization. Really, like I mentioned in previous videos, we're a risk management firm. We're not an insurance company in the traditional sense. There's a lot of insurance companies out there, but man, there's only like 2 or 3 risk management firms in the state. So we look at kind of the whole picture. So a company comes to the Starr Group and they work with me. And I come to you and I say, look, we want to get this guy set up in this type of program. What you tradition would do is say, all right, we're going to find a place to put the workers' comp, get a good dividend, and then amongst these other 18 lines, build it into this program. Am I understanding that correctly?
Absolutely, absolutely. We're going to take the attritional line, so we're going to find out which lines of your business are making or would make a profit or the largest profit in this program model. And then again, it's a very well calculated procedure where we can actually provide an accurate synopsis of what this would look like for you moving forward before you make any commitment or determination. Any lines that don't go into this program, no problem. I mean, we have access to every heavy-hitting guaranteed cost program in the marketplace, so if we find that your commercial auto or your cyber or some of your management liability lines haven't performed well, we can keep those separate, still in a competitive guaranteed cost program, and then again make sure that you're capitalizing on what is been favorable for you. So again, it's a very, very easy process. And one other note that I want to make in that regard is even better, this particular model mimics what you have in place currently. So it actually takes the remarketing process out of the spectrum, and everyone knows one of the biggest pains is the remarketing process. Granted, we take as much of that legwork off of the plate for you. However, this program mimics your deductibles, your rates, and your coverages, and basically just applies this 10 to 50% return premium option.
And that's great.
It's huge.
So as we wrap this up, let me ask you this. Let's say you got somebody who has the premium in order to make this program work, but they're sitting around 45 to 50% loss. What is one of 2 things that they could, if they come to us and want this program, but they're at that ratio, what could we do to make sure that they are better qualified for this program in the short term rather than 3-5 years from now?
Absolutely. And any relationship that we have with our clients is going to be a functional relationship, a strategic relationship. So we've surrounded ourselves with specialists, industry specialists that can be hands-on with your organization to dig into the specific losses that you've had, and let's attack those. Let's look at them. How did this happen? How are we going to prevent it? And it can be as micro or as macro as you'd like it to be. So the idea is to continue to evolve and get to a point where this program might then be a fit. And even if you have over 40%, that doesn't necessarily mean you're exiled from this. We can look at it and say, what happened? Why might this be a one-off? What's the narrative moving forward? Why won't this happen again? So you really have the decision-making power, and again, we've got the tools and specialists. We've got a very, very sharp captive specialist who plays on the front lines with us in this regard that can help determine, what's going to be the best route in the short term, guaranteed cost or moving to the captive.
And that's what it is, man. We customize and tailor every program based upon the needs of our clients. So if you have any further questions on this program, I know it can sound a little bit complicated, but on the surface, it's fairly simplistic. So if you have any additional questions, you can reach out to Nick, you can reach out to me, and we can answer these questions and really see if this is the right program for you. So until next time, you all have a great day, and we'll talk to you soon.